Hi, and welcome to the Investing the Templeton Way podcast. I'm your host, Lauren Templeton, and you're not going to want to miss today's episode with my friend and business associate, Mr. Ben Watsa. Ben is the president and founder of Marvel Capital Limited. Prior to Marvel, Mr. Watsa was a partner and portfolio manager at Lissom Investment Management, Inc. for over a decade, and spent 5 years in New York as an investment banker in the Financial Institutions Group at Bank of America Securities and at Cochrane Coronia Waller. Mr. Watsa serves as director of Fairfax Financial Holdings Limited and Fairfax India Holdings Corporation. He also serves on the advisory board of Impression Ventures and holds the position of Director Emeritus for his work and contributions as a director and the vice chair of the investment committee for the Rideau Hall Foundation. Mr. Watsa was recognized as a top 50 under 50 Indo-Canadian leader and is also a member of the Young Presidents Organization and a member of the Toronto Club's membership committee. Now, it is worth noting in this episode that both Ben and I serve as directors on the boards of Fairfax Financial Holdings Limited and Fairfax India Holdings Corp. I serve in the capacity as independent director, and Ben is a non-independent director. Ben Watsa is the son of Prem Watsa, chairman and CEO of Fairfax Financial Holdings Limited, and chairman and founder of Fairfax India Holdings Corp. While the focus of this episode will be on Ben's successful career as an investment manager, it will be difficult to avoid entirely the topic of Fairfax. And Ben will, I think, obviously have been heavily influenced by his father, legendary investor and CEO of Fairfax, Prem Watsa. It is important to note that the opinions, insights, and information shared during the podcast may be influenced by our affiliations with these organizations. As directors of Fairfax Financial Holdings Limited and Fairfax India Holdings Corp., both Ben and I have personal interest and investments that are related to the companies discussed on this podcast. This may create conflicts of interest or biases in the viewpoints expressed. We have a financial stake in the success and the performance of Fairfax Financial and Fairfax India Holdings Corp. I would invite you to please remember that as you listen to the podcast. But again, the focus of this podcast will be on Ben's investment career and his portfolio management style. Thank you for joining us today, and I hope you enjoy this conversation with Ben Watsa. Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Welcome to the Investing the Templeton Way podcast. I'm very excited to have today's guest and to welcome today's guest, Ben Watsa. Welcome, Ben.
Thank you so much, Lauren, for asking me to do this podcast. I really appreciate the opportunity. I actually haven't done any podcasts in the past. I look through the caliber of guests that you've had on, and it's very humbling to be asked to be here today. I listened to some of your previous episodes and admire what you've put together, and this archive of material will really broaden the value community and grow the family. so to speak. So I'm thrilled to be a part of it and humbled to be asked.
Thank you so much. It's a lot of fun to produce these episodes.
Yeah.
I think I get more out of them than anybody else. Getting to talk to really smart investment managers, authors, academics. It's a treat and it challenges me every time.
Before we start off the questioning, I wanted to bring up a couple stories on Sir John.
Yeah, I'd
You know,
love to hear
I thought
them.
this is the appropriate place to do it. And he has such a deep connection with us. I was just talking to my dad, who's the CEO of Fairfax, and he wrote Sir John a letter in 1978. And Sir John invited him to meet him in Lifer Key. And he met him annually for many years. And they developed a great mutual respect for each other, particularly Sir John getting to respect my dad over time. My dad already had that respect because he'd been following Sir John's career. Hamlin Watsa is our investment counselor at Fairfax, and that's where all the insurance float is managed, as you well know. But at the time, it was a separate entity. It wasn't fully owned by Fairfax, and it managed outside capital. So about $1 billion of pension funds and foundations. And the investment team, my dad, were worried there'd be a conflict of interest of having Hamlin Watsa in manage outside capital. So they wanted it to be a wholly owned subsidiary of Fairfax. And to do that deal, they wanted the shareholders' approval and to to see that it was a fair deal. And Sir John had become one of our largest shareholders, actually. And so my dad went to Sir John and said, "This is what we're thinking. We want you to look at the deal, and if you approve of it, then we'll go forward." And Sir John approved of the deal and thought it was fair on for both sides, particularly on Fairfax's side because he was a large Fairfax shareholder, and had the deal done. So that's just one of the
I
connections.
love that
Yeah.
story. I know that John Templeton held your father in very high regard, and I love it. I'll share with our listeners that your father commissioned a bust of John Templeton, which is in the Fairfax boardroom. So I see it every quarter when I go in. It always touches me to see it. And then there's also another copy of it, which sits in the Templeton Library in Swanee, Tennessee. So that's a really neat thing as well. But I know they met annually at Lyford Key and maintained a deep friendship over the years. So that's really special.
And there's one other one where Sir John had told my dad that Fairfax had amongst the best disclosures of any company he had ever seen. And I know I listened to your podcast with your husband, Scott. And when he was talking about Sir John, he said that Sir John described himself as a business analyst. And so for him to say that meant a lot. And when we were getting attacked by the shorts, so Fairfax was shorted heavily. There was a bear raid going on between 2003 to 2006. And my dad had asked Sir John, can we use that quote in one of the articles that we had coming out about the company? Because there was a lot of questioning of whether we had proper disclosures from what the short sellers were putting out there. And Sir John allowed us to use his quote. So he's always been just a guiding light for my dad. And I had a deep connection with Fairfax. So again, this is why just being on this podcast with you here is a special moment for me. So thank you very much.
Oh, that's wonderful. And I should also tell guests there's a podcast that I was on with Guy Spear, and Guy asked me, how did you get to be on the board of Fairfax? It may be worth telling that story as well. Sir John did not introduce me to your father, but I had learned after the passing of John Templeton that he had this friendship with Prem Watsa, and I was very curious to meet CEO of Fairfax. My husband and I had started accumulating shares of Fairfax, and I wrote to your father and asked if we could come to Toronto and meet with him. And my husband, my father, my mother, my firstborn child, who was probably 2 years old, we all flew to Toronto, rented a car. We went to meet your dad. I can remember meeting with him in the office, Dad, Scott, and I. Then we drove to Niagara Falls. And then we started attending all the AGMs. Dad used to come with me when he was able to attend, and accumulating more and more shares over the years and becoming more engaged with Fairfax. So that's really my Fairfax story, but it is special, that history with John Templeton and Prem Watsa. I know it's special to Prem and it would have been special to John too. So it's extra special to have you today. So let's put the focus back on you.
Yeah.
Ben, could you start by sharing some of your early influences and experiences from your childhood that have shaped your interest in investing and finance?
Before I go into stock markets, I experienced my own tulip bubble. Before getting into investing, I loved collecting sports cards, particularly baseball cards and hockey cards. And so when I was growing up, I was born in 78, the trading card bubble, there was a big one between 87 and 95. I was collecting cards from about the time I was 5, from 83 till about 92. My allowance used to be a quarter a week when I was growing up. We lived in a small town, Newmarket, and across the street was a Becker's, which is a convenience store. So I'd go there and buy a pack of cards every week and collect them. And anyways, as it got more popular, there was a magazine called Beckett, and you could go to the convenience store and you could look through a few pages and look at the prices every month of your cards. And the better a player did, and as demand went up, the price would increase. And there was no internet back then. So that was the only way to find out the value of what you were collecting. And I would have debates with my dad on the merits of the value of collecting baseball cards. Obviously, he didn't think there was a lot of worth to them. And he turned out to be right. They weren't worth less, but they're not worth a lot, let's just say. But I do think if there's parents listening with young children on here, I think it's a good thing to encourage them to collect things because it is a little bit tougher to get them involved in the stock market at an early age. But if there's some toy or something that starts going up in value, for them to collect it at a cheap level is good, and they'll track the price and everything like that. That was a lot of fun for me. And I used to study the baseball almanac and trying to figure out which players would be better. It was fun. And now going back to the stock market, early on, I'd say my big influence was Irwin Toy, it was a distributor for American toy products in Canada. And they had uh, a program for children for stocks. They wanted to engage children into the stock market. So we'd go to the annual meetings, and my dad bought me some shares and my two younger sisters, and we'd go to the meeting. But what I remember, because I was between 7 and 10 years old, what I really remember is at the end of the meeting, you got to play with the toys and test out the new toys that are going to break the margin. So that was a lot of fun. But I also remember on a quarterly basis, we would get dividend checks and they'd be like 20 cents, 50 cents, whatever it was. A ton of money. But at that time, getting a quarter a week allowance, I was like, wow, you actually get paid for this. And I wish they still had that because my daughter and my son, I have a stock portfolio for them, but they don't get the physical dividends. They just go right in the account.
Yeah.
Yeah.
I know. I always remark on that same thing. So I had stock certificates on the wall of my bedroom growing up, and one of the stocks was Shoney's, and one of their dividends was a free dinner. So if you own one share at one time, that was a huge dividend yield because the stock price was so low that the meal was far exceeded the cost of one share. But I liked that strawberry pie they had. So that was a good stock for me to own. Are your kids interested in the stock market?
They do have their stock portfolio. So they're not things that I would necessarily own. They have a couple things that I would own. It's what they're interested in. So they both own Netflix. I do own Spin Master. So they have invested in that stock too, which has Paw Patrol as one of their big franchises. I got involved in the pandemic with that stock. My son owns Sega Sammy. So Sega, he likes Sonic the Hedgehog. He owns Nintendo stock. Yeah, likes Super Mario. What else? He bought Roblox. He doesn't even play Roblox, but he knows about it at school. So he bought that. I tried to tell him about valuation, but he's 8 years old. So he bought that. They both own Disney. My daughter has General Mills because she likes Aunt Annie's pasta. So they've gone the Peter Lynch route of picking what their interests are. My daughter's getting into it more. She also collects Squishmallows. And actually, Warren Buffett owns a company. So when I told her Warren Buffett and Charlie Munger, they've made Squishmallows of them, she wanted them desperately. But I wasn't at the meeting to get her one. But I wrote the company, and they were nice and sent some PDFs of for them to color. But they only sell them at the meetings, unfortunately. I think you actually got a couple.
I did. One of my proudest parenting moments was having my girls in a huge argument at the Berkshire Hathaway shareholders meeting, arguing over who got Warren Buffett and who got Charlie Munger. By the end of the day, they had totally reversed their positions. The person that wanted Charlie Munger now wanted Warren Buffett. I thought they were going to kill each other over it, but we now are the proud owners of two giant Warren Buffett and Charlie Munger squishmallows and quite a few stuffed geckos, too. That is a really fun story about your kids, and I'm glad you're getting them involved in the stock market. Do you remember your first stock that you purchased?
It was Fairfax. So when I had a paper route and I was earning about, I think, $7 a week, some of it was for spending and some of it was for savings. And the savings would
Uh-huh.
then go into Fairfax shares.
Oh, I love
Uh,
it.
That was my first real stock that I had
Yeah, I'm
purchased on my own
impressed with
independently.
the paper route. So did you do that on foot or bicycle
On
or
foot, it was the Toronto Star, and you get a bag to carry it around. As I had more and more papers to deliver, I got a wagon that,
Oh,
that I took around to deliver in the neighborhood. No matter the weather, you still had to deliver the paper. So it gave you some good discipline doing it. But I think what they started to do is they started to get rid of the kids and get adults who had cars that could deliver tons of papers. So I was at the tail end of that, less using children to deliver the paper. Anyways.
no children workers. I love to see your daughter at the AGM stand up and ask questions. It just, I love it. It makes me so happy.
Yeah, she's even when I told her I'm doing this, she made me a little card and everything. She's really a sweet little girl. So
Yeah.
my son is
Yeah.
very sweet too, but
And she
a
asks the
lot.
tough questions.
Yeah. She gets up on her own, and I don't want to discourage her from asking a question at the meeting. And it's great to see the passion that she wants to do it and that she has the courage to get up there and ask.
It's
What?
great.
Yeah.
Yeah. So proud of her. I know Prem is too. And you are. What a smart young lady.
No.
Your father, as I think everybody knows, is a very famous and successful investor and businessman, well known as an investor and also CEO of Fairfax. How has his success influenced your career? And why didn't you join him at Fairfax, Ben?
That's a great question. And I often think as I get older that I'll be 45 in a month, and I think, why am I who I am? And the intelligent investor, there was a quote in it that always stuck with me. Life can only be understood backwards, but it must be lived forward. When you have a parent that's quite successful, you can have a big influence. Having my own kids, I see how much influence I can have, but you can shape their interests to some degree. And when a parent is very successful, the early insights into a career that made them successful, the parents can pass along to the child. So the child actually gets these insights that it would have taken myself a few decades probably in a career to really understand. When I look at my dad, he was introduced into value investing at his first job by his boss. And his boss gave him the intelligent investor, said, this is the only way to invest. And he loved it so much. He named me Benjamin after Ben Grant. That just shows how much he actually
I
fell in
love
love with
it.
the concept to name me after him. And so I grew up thinking value investing was the only way to invest. I
Sure.
equate it to like a religion. You're born into Christianity or you're born as a Muslim or something like that. That's your religion you follow. And he also put the best investment books in front of me. And so by the time I was ready to become a professional and start working full time, I already could visualize being successful in investing because I saw a way to do it. And for me, when I was thinking, what book really did it for me? I thought Money Masters was yeah, John Train, the pivotal book. And it's unfortunate it's out of publication. Perhaps you can find it online as a PDF or something. So what it did for me over all the other books, I realized how creative the feel of investing was. It wasn't just this one way to do it, even if you're a value investor. And they give you profiles of Warren Buffett, Ben Graham, Phil Fisher, Larry Tisch, and of course, John Templeton. And actually, his profile stuck out to me the most, Sir John's, because the two examples that I love, one is that he bought $100 of stock in company shares trading under $1 in value. So it was 104 companies, like 10 grand, and he made four times his money in 4 years. So I remember that example. I thought, wow, that's a neat thing he did. And then also he listed the questions he likes to ask management. And mistakenly, I thought, oh, okay, I got the questions here, but you need to read a lot to understand the meaning behind answers from those questions. But that book really stuck with me. And of course, again, my philosophy is shaped by numerous value investing books that my dad gave to me. But that motivated me to get into the investment business. And then why I didn't join my dad, I had this in my head thinking I wanted my dad as my dad and I didn't want him as my boss.
Yeah, I understand that.
And after working for bosses, it's a different dynamic. And so I've been in the investment industry now for 22 years, and I am very happy with my decision. I'm involved serving on the board, and the company will always be professionally run. So I think that's an added benefit, not to be engaged on the day-to-day workings of the company. And then the other thing is we're always going to have an internal candidate for Fairfax. And I speak with multiple Fairfax executives many times a year on a quarterly basis, on some on a monthly basis, and I get updates on their businesses. And this is more, say, the billion plus in revenue businesses. And you develop a good relationship with them because I think business is about relationships. And then my dad, on a weekly basis, we're talking shop all the time. And we talk about personal stuff, but we always love discussing also what's going on in the business world.
Yeah, and you play tennis with him once a week, right?
I play tennis with him once a week as well. And yeah, that's quite a battle. I don't play that often. I only play him once a week, but he plays 3 times a week. So even though he's 28 years older than me, it's tough. He's got experience and he's got the practice, the 10,000 hours. And I just have a youth on my side and a will to win.
I
So
know. Is it bad? I'm really curious who wins these matches.
I won the last 2. I'll say that. But you know what? It can go either way all the time. What's good about it is we're close in skill, and it's whoever's getting their shots that day is going to win.
He does love tennis. I know that about your father.
He tries really hard. I'm worried that we're going to have to slow it down a little bit. It gets over.
Yeah, you don't want to reach for too many
He
balls.
runs hard for shots. So don't be surprised if one of us has a broken arm or something at some point in our battles.
One of my favorite memories is playing tennis with Tony Griffiths one time in Toronto, who was a Fairfax director and also a really big tennis player.
That's one of the reasons my dad plays is because Tony was able to play multiple times a week into his 90s. And he attributed his being limber and with it because he could exercise by playing tennis. And so my dad's, okay, I got to make this part of my routine so I can do that.
I think it's really good from a cognitive perspective too to play tennis.
Right.
They say it's really good for your brain.
Yes.
Not that your dad needs any help in that department, but
But it's good to keep adding your routines that
Yeah.
he's always loved tennis, but he's just made it a point to do it 3 times a week now. So that's been great for him.
and you have
And
siblings,
yes, I have 2 younger sisters. Yes.
very close family.
Very close. We all live within 5-10 minutes of each other. My middle sister has her 3 children. 2 of them are the same age as my 2 children, 11 and 8. And so
So
they're very close. So we get together and they spend a lot of time together. My youngest sister is great and we have a monthly lunch where we get together, just the 3 of us, and talk. And when my sister turned 40 last year, the 3 of us went away on a trip by ourselves. It's really hard when you have family get-togethers. The kids are around, the parents are around. It's very hard to get that connection time because everybody's there. So that's why we try to do things alone as well, so that we can connect.
that's wonderful. I'm sure it's a very unique experience growing up with Prem as a father and watching Fairfax grow over the years.
He's been a tremendous example for me in terms of how to run my own firm and treat people. I have 2 small and mid-cap funds. One was North America, and then I launched an India one. And in terms of not getting back to whether working for him or not, by launching that fund, I deepened my connection with India and expanded my network. And when I started my company after 16 years, the people that backed me were my friends, my family, my colleagues, business associates. And I wouldn't have really grown from that experience if I wasn't doing my own venture.
Yeah, I've read your investment letters preparing for this interview, and I'm really impressed with the letters. I've enjoyed reading them. They're well thought out, written. When you describe your investment thesis for different stocks, it makes a lot of sense. I'm very impressed with your letters, and I can tell you spend a great deal of time on them.
I tried to, yeah.
Yeah, your father's known as a great letter writer, so obviously the acorn didn't fall too far from the tree. But let's talk about your long journey in the investment world. Can you detail how your professional strategies and philosophies have evolved over time?
Yeah, I'm a former investment banker. I spent my first 5.5 years in banking. And at that time, when you're just told what to do. You're told what to research, and you don't know what to research at that point in time anyway. So you got to soak up and learn what you can. And now at this point in my career, I can direct what I'm learning about, what I think is important. And more, now I take, you mentioned my letters, I take them as an opportunity to educate my clients through what I've learned and also verbally too, but through the letters. And what I'm trying to do is make my client better value investors. So that makes sense because it makes our fund better. If you have a stable and wonderful client base, that really contributes to excellent returns. You don't have, for example, the pandemic happens. We didn't experience any redemptions during that period of time. And in fact, they actually contributed capital. I wrote to them and said, now is the time to put money into markets. And the main message is that to stay invested during market downturns, this too shall pass. As there's younger listeners to this podcast, that's the message. Don't get out during a severe pullback anyways. It will pass at some point in time. When I look over my letters, and this is why I'm honored to be named after Ben Graham and Warren Buffett still, he talks so highly of him because the concepts that Benjamin Graham came up with in The Intelligent Investor. When I look over my letters and I look at Warren Buffett always talks about chapter 8 and chapter 20. So chapter 8 has parts on market fluctuations and Mr. Market being this manic depressive that offers to buy and sell your stock at highs and lows and that you can't time markets. And then chapter 20 talks about having a margin of safety and being diversified. And so those concepts, when I look at my letters, I see myself somewhere explaining these things constantly and because I'm finding them the most important things too, but all comes from Ben Graham. And so
I was just leafing through the letter because there was a great line in one of your letters that I'd underlined, but I think maybe I don't have the right letter in front of me, but it was about just an investment manager's success is very tied to the behavior of your clients or something like that. It was said so well. And I thought, wow, that's a really great way of putting that. But of course, I can't find it now. Do you want to explain to listeners how the name for your business came about? That's interesting too.
sure. Yeah. My name came about. So Marval, Mar stands for margin of safety. Val stands for value over the long term. And so I just put that together. I thought those are two central concepts to value investing. MCL are the initials of the company. My wife's name's after M, my daughter's name's C, and my L is for my son. And so tried to come up with something that would fit. Jumping back to what we were discussing on investment philosophies, I went through the great financial crisis and going through that made me very aware of leverage and careful of leverage. So half our companies in both portfolios have a net cash position. They're very conservative. They can survive. They have optionality and can benefit if there is a downturn because they have cash to make good decisions. And then I also like having high levels of free cash flow and high returns on invested capital. And then in terms of influences, investment professionals that everyone would know, Warren Buffett, his genius to me is that he can identify companies that you can hold forever. And Michael Price, who trained Seth Klarman, holding a cash position and the power of having cash allows you to do other things because you have that cash position. And it can be of value at certain points to keep some money aside rather than having it 100% invested in the markets.
Yeah, especially today when you can get paid a little bit on it.
Yeah, the T-bills are suddenly a viable option now. That's great.
It's nice.
Yeah, it really is after a decade of not being able to, what do you do with cash that just sat there and didn't make any money? Joel Greenblatt, again, for spinoffs. And if you haven't read, You Could Be a Stock Market Genius, I think it's a well worth a read in terms of understanding how to take advantage of spinoffs and always paying attention when a company has a spinoff.
Yeah, you too can be a stock market genius, right? Yeah. And then Charlie Munger.
Charlie Munger on quality. If you listen to him, he always talks about Costco. And it just reminds me, you don't have to do a lot of things, right? Stick with it. Don't get moved from that investment.
And of course, he taught Warren Buffett that when they purchased See's Candies, that was the first transition at Berkshire Hathaway into quality businesses and the idea of you can pay a little bit more for a quality business.
Yeah. And as Berkshire Hathaway got bigger and bigger, it couldn't just move from one company to the next as easily.
Can you give an example of one of your successful investments? And I think it would be good to also maybe hear about a failure and what key lessons did you learn from each of the experiences?
I started managing money in 2012. The first big investment I came across, Cray, in 2011. And at that time, and still to this day, actually, data is doubling every 2 years. So every 2 years, we create more data than has been created in human history. And I just thought if you could analyze that data, you'd have a competitive advantage the quicker you could do it. And so Cray is a supercomputing company, and they were building shovels for the gold rush. They were helping build the tools to analyze that data at the highest level. And if you think of a supercomputer as really a computer that costs over $10 million, but Cray is even at the high end of that. What got me interested in it was that IBM had this $300 million contract from the government to build a supercomputer for $300 million over 3 years. And IBM wanted to use standardized software and parts. And that doesn't work for a computer of this size. You need entrepreneurial, creative thinking on how to alleviate all the bottlenecks that are going to go on in a computer the size of a Walmart supercenter. You can't just have standardized parts.
Yeah.
And just an example of the power of a computer this big, if one person were to multiply two numbers together and they did it every second, it would take 1,000,000 years to do what this computer calculates in 1 second.
Yeah, it's amazing.
So Cray took over the job and started delivering within 8 months. So that to me, that said, okay, there is something special about this company. And so they got, I think, about 190 million on that contract. And their revenue for the prior year was 236 million. So they get 190 million from one contract. They also got a contract from the Department of Energy that was nearly $100 million. And that thing used 19,000 16-core processors. And
Wow.
power it uses would be to power 9,000 homes. The revenue and earnings are so lumpy that the stock would move 30, 40%, whether they made earnings or missed earnings. And no one really on the street covered it. So you would have opportunities to get in and out of the company and trim and add to the position because Mr. Market was so pervasive
Erratic.
in that investment. And it actually gave insight into what was going on with other countries like China. China went, I think in 2015, they only had about 7% of the top 500 computers. In 6 months, they went to about 22% of the top 500 computers. So they had given their plan. They're going to invest heavily in technology, and you could see it in this industry. And today they have about half of the spots in the supercomputer list. America has about same 22% and focused on having the most powerful computers. And Cray is also tied to the defense budget. And so we thought even if the defense budget were to shrink, spending in this area would still increase because there's so much to gain from using it. And they even built the computers for the NSA. But I also thought that data analytics would unlock efficiencies in other industries as well. And just one last example on that, a pharmaceutical company, if they use a home computer to analyze billions of points of data for 100 million people, if it could even do it, maybe you'd get 12 results in the year, one a month or something like that. Now, if you build a very expensive computer, you can get 500,000 results. And then your supercomputer can then analyze that. So Cray used the example, you're finding a needle in a needle stack. And that can be the connection to curing a disease. And so that's why you'd use them. In terms of valuation, the company, when we got involved, 250 million market cap, had 50 million net cash. It was about half of sales and 2 times free cash flow. And we bought it for about $7 in 2012. It went to $35 because it was sold to HP. One example they gave, if they had a voice sample of a terrorist and there were 200,000 phone calls going on in Manhattan, they could tell you which phone's making that call. So we thought it has to be hidden in a bigger company, what they're doing. And so HP actually ended up buying the company and it worked out well for us. Warren Buffett talks about omission versus commission, and
Right.
omission are the bigger errors. Okay. We bought Cray at half of sales. So when I was asking them, what kind of processors do they use? What, is it Intel, CPUs? And they told me, no, they use NVIDIA. And NVIDIA were harder to program, but much more powerful. And these are graphic processors, the difference between a computer processor and a graphic processor. So NVIDIA was trading at twice sales, and I'm buying Cray at half a sales, so 4 times cheaper. And I thought, no, so NVIDIA is too expensive at that time. So they had about 8 billion market cap. Now, NVIDIA has gone up over 100x in 11 years. Okay. Now, my only solace when I think about it is I already thought it was expensive. I've since adjusted myself. Would have paid twice sales back, but if it went to 16 billion, I probably would have sold it along the way. There's no way I would have held it
Right.
to realize the 100. The discipline of being a value investor, I wouldn't have been able. But I did learn from that failure and the success of Prey in terms of when I'm looking in India for these kind of tech opportunities that haven't been fully discovered. We came across a company called KPIT Technologies that makes the autonomous driving software for cars. It makes the battery software and connecting the cars on the road. And they have a team that's bigger than any individual automobile OEM. For example, BMW will use them for their software, and then they will just customize it to make it look like BMW software, but the white
Okay.
label is from them. It was mid 20s in terms of earnings, and we sold it after over a year. It went up 6x. But so we learned from that and tried to are a little more open minded when we see that kind of thing. And using Charlie Munger's quote, all smart investment is value investment as a principle on looking at certain tech stocks that you're catching them maybe a little bit earlier than other people are noticing them. So
Mhm. That's another thing I like about your letters is that you use great quotes throughout your letters. So I always like to read quotes, and your letters were great. You had some good ones in there.
love quotes that help shape what you're writing about. Arnold Vandenberg's shared with me one of his quote books. He gave a Google talk and I listened to it and then I wrote to him because he mentioned the quote book in it. And then he sent it to me. So he sent a copy for me and my dad. And I just thought it only had quotes in it, but I thought I should use more quotes for my letters.
Awesome. I have his quote book on my desk. He's a great guy and has been a guest on the show, as you may know. Can you talk a little bit more about your investment activities? Because they span India and the US. You have a North American fund and a fund focused on India. Can you discuss the different dynamics between the markets?
Sure. The US and India, they're both very deep markets and they both really have their homegrown companies that dominate. And they're both consumption driven economies. So the US is in the high 60s for consumption and India's around 60%. But one thing that's different between the markets is that from a value investment perspective, deep value, I don't believe that works in India, but it does work in North America. And the reasons I see is why it doesn't work in India is so India is a growth market. Bad companies might be growing at 10% a year. So if you're really cheap, if you're like trading at under 15 times earnings in India, you might have corruption, you might have excessive leverage. Part of your business might be becoming obsolete, or maybe you're a government run business or some combination of all of those. So the most risk are the cheapest companies in India. Whereas in the US, you can still find a good margin of safety in deep value companies. In India, we've sided with market leading companies and small and mid caps. The difference here is the collective market cap of US companies is around $40 trillion. And India is less than 1/10 of that. So it's about 3.5 trillion. And then the average American makes 30 times more than the average Indian. So the average Indian is making about $2,500 a year. Average American, I think, is 76,000, something like that.
And the middle class is projected to really grow in India.
That's right. So when you go to India right now, and this is where there's a lot of low hanging fruit because there's only 200 million people that are really participating and make up the consumer class in India. But by 2030, they think that'll grow to a billion people to your point, Lauren. India's really starting to take off now because they've become much more business friendly. So there's certain sectors that are doing well too. So Make in India is an initiative where they want to increase manufacturing. So manufacturing right now is about 18% of the economy. They want to move it to 25%. Now to increase it to 25% when the economy is already growing at 6, 7% a year, you have to give massive incentive. What they have going for them is that China's population by 2070 right now, the estimates are India might have twice the population of China.
Because China's declining.
So if you see someone like Apple, that's why they're investing to manufacture in India now. And, because they're going to still have that big working age population when you start looking decades out. And then if I give you an example, like the banking sector 15 years ago in India was 90% run by the state owned banks. Today, it's about 60%. And the private banks, they're growing at 20 to 30% a year. They're taking lots of share. So there's lots of opportunity in different sectors. Then a great operator can come in and dominate a field. So for example, just over 15 years ago, Indigo Airlines was created, and it was started by the US Airways CEO. And he put in an order with Airbus because he thought they were the most fuel efficient. And he specified the parts, and then he leased them. So he had a lower cost, but he went to Airbus and said, I want 150 of them. And Airbus only entertained it because he was the former US Airways CEO. They delivered that. Then in 2009, he orders another 100, 150 planes for them. And no one was ordering planes. So Airbus went and said, okay, we will deliver those planes. Now, India today only has about 700 to 800 planes for domestic travel in the whole country. America has less than 6,000 planes, and China has about 7,000 planes. So India's like a tenth of China right now, but also earns less. So less people can travel. But in the last year or so, two companies in India, Indigo being one of them, and the Tata Group have ordered 1,000 airplanes more. So to quote Wayne Gretzky, that you can see where the puck is going in terms of travel. The number of consumers moving to the middle class that will be able to consume. And so I'm very happy for the Indian people that this is happening, because I've been going there since I was 6 months old in 78, but been going there my whole life. And the levels of poverty, it's the one place that makes you almost want to get into politics to help the people, because you don't see the politicians really helping the people. But now we've got Prime Minister Modi, who's the first business-friendly government India has ever had, and taking them from socialism to capitalism. And so what's happening is the brain drain that's been happening, where people like my dad left India because there was no opportunity for them. I'm telling my dad now, hey, you know what? The opportunity for my kids, they might have to go back to India. Modi had this quote, instead of a brain drain, it's a brain gain, because people will start coming back. And animal spirits are starting to work in India. So in 2016, there was only 1,000 startups in India. Today, there's over 90,000.
Wow.
And India, because being business friendly, is allowing the markets to decide who the winners are. So I'm very happy with India. And why I decided to create a small and mid cap fund, this is where I compared it to the US. When I look at my favorite investors, so I mentioned Michael Price, Seth Klarman, Joel Greenblatt, Warren Buffett, where he grew tremendously. My dad, in the beginning of 1979, America was a $2.5 trillion economy. And by the end of 2000, so 22 years later, it gets to $10 trillion. So that's a 4x growth on the economy. The S&P 500 compounded at about 17% during that time. So there was the opportunity to do really well in that environment. Your money doubles at 15% every 5 years. When we started in mid 2019, India's economy was around 2.5 trillion. It's getting to 10 trillion in about 17 years, plus or minus a few years. That's a very fertile environment. And the chances are that India's stock market will compound at a high level, just like America did, because they're under a capitalist society. The top 10 companies in India are about 40% of their S&P 500. So these emerging market funds, they have about 10 to 15% of their investment in India, and they only invest in the top 30 companies primarily.
Right.
I'm generalizing here. But so we saw the opportunity to get a small and mid cap fund and go a little deeper, find some market leaders and do well there with our network and checking out who the founders are. So we've been building our business, and it's been a great thing just to educate Canadians and invest them in Indian markets. I hope that gives some color as to the differences and similarities of India and the US.
It really does. Now, your North American fund, it is focused predominantly on US securities.
And Canada. Yeah, that's about 80%, I would say. Yeah.
Yeah. Again, your annual letter for the India fund, especially for 2022, described a lot of those dynamics in detail and was very interesting. Blown away with some of the initiatives I see coming out of India. It's really interesting. Ben, is there a particular achievement, a recent achievement that you're proud of?
I launched my India fund amidst a non-banking financial crisis in India, which really started from 2018 going into 2019, accelerated in the back half of 2019. So we launched this fund. I got all my friends, my family members, colleagues, business associates in it, and it's going down. And then we rebound somewhat in January 2020. And I'm feeling better because all these people are trusting me to go invest in India with their money. And right now it's a concept, and they all backed me. And then, of course, COVID hits in March 2020, and you're down another 30% in the month. We didn't lose any investors. They trusted me. And so I'm so grateful to them. And by the end of the year, who would have thought in that 2020 year, lockdowns, zero revenue, the market will be up after all of that at the end of the year. And we had about a 26% return in 2020. And then in 2021, we were up 59%. And then we were down about 6% last year. But these are all short term numbers. I tell people I'm there for over 30 years. India is the great growth story of our generation. And when I looked at my career and thinking out to when I'm 60 years old, what would I regret not doing? And I thought if I just focus on North America when I know what's going on in India, I'd regret it. And India right now, it's a $3.5 trillion economy. It expects to be at 7 trillion by 2030. Now, if you just think of that, that's doubling everything they've ever done in their history in the next 7 years. And just to put that in a US perspective, that's like adding another, I know it's not the same size or anything, but it's like adding another Apple, Microsoft, Google, the entire US banking system in 7 years. That's what they're doing for their own economy. So I'm just so excited to be part of it.
That should
Yes.
be something you're proud of, and it does. And I'm going to push on that just a little bit because it reminds me of Sir John's investment with Paul Matthews and his Korea fund on the heels of the Asian financial crisis. It was a really funny story about that. So evidently things had gotten so depressed in the Matthews office that they had bought like a ping pong table and they just played ping pong during the day. And then this fax came through from John Templeton saying, I'm going to invest in your Korea fund. They had been like the worst performing mutual fund ranked by Morningstar that year. And Sir John invested in the next year. They were the top performing mutual fund, which says a lot because it was during the tech boom and they beat the high flying tech funds. I just want to push on that experience a little bit. What was that like in March of 2020? You just launched this fund, COVID hit.
I looked at it as, okay, I was pretty concentrated in both funds. And what I did there was I decided to expand the holding. So anything that fell in line with markets was on the table, ready to be sold. If I could find something that was a great quality company that for no other reason than the market panic fell twice the market. So 60, 70%. That's what I was looking for. And so we were able to find some of those. So we were even in North America, we were up 25% in 2020. And that's what we did. We tried to take tax losses where we could and then put them in great companies that we thought we could hold a long time.
Upgraded your portfolio.
Yeah, yeah, in a nice way. We have great companies, but yes, if there are opportunities in things that might be even better, yes, then we will do that. And the nice thing is that we're not very big, so we can do that. And then that's the strategy we took. And there was a little bit sleepless nights in the sense that I'm trading in North America during the day and then India at night as well. And then I usually only communicate with clients every year, unless I have something to say or something's going on in market. And I communicated over 10 times, I think, through letters that year to clients because I wanted them to understand what was going on. And I told them, even I think in one note, take your statement, write down what you're feeling, and look back at it in a year.
Oh, interesting.
Because I guarantee, like I didn't guarantee, but I did say that I think we will be in a much better spot in a year from
Yeah.
now.
Yeah. We don't guarantee anything in investment.
But at that kind of panic and what was happening, it would be hard for it to continue to last. I think they were quoting death rates of 3 to 5% at that time. And the one thing that was different in that crisis was a health scare on top of it. So that
Yeah.
was worrisome, especially when you think of your parents and people that were in the age demographic that could be impacted by it. There's a lot of uncertainty, but it created an opportunity for good companies. And again, I throw over my framework of trying to reduce risk of having cash-rich companies that are good free cash flow and that have managed themselves in a conservative manner so that they could go a year without revenue and still survive. Sure. So I wasn't worried about our companies. I get excited by downturns. If you're a true value investor, a lot of times you're not involved in what's causing the crisis. And I'd go back to the great financial crisis as more of a normal thing where people got in excessive leverage. You're not involved with what drove the market up. So you're not fully participating in normal circumstances when it goes down. And so you get excited because you're seeing all these opportunities that you weren't able to take part in. There's these businesses like I mentioned Spin Master. I thought people would still buy toys. And in fact, I thought people would buy more toys if we have to stay at home. because I have two
Yeah.
kids. They were 7 and 4 at the time. I'm like, we need to get some toys in this house for them
Lots
to
of
play
toys.
with.
Yeah.
Because you're trying to do a call, and my 4-year-old did not care what I was doing. And I remember even my 7-year-old, my daughter at the time, she came in, I was on a call, and she yelled at me like I didn't make her lunch because my call went through lunch. And so my wife was out at the time. I don't know if she was walking around the block or whatever. And my daughter's, you didn't make me lunch. Da, da, da. And it's, just a moment. Let me just put this on mute, please.
It's stressful. I was stressed during COVID. I, like you, look forward to moments of maximum pessimism so that I can go in and take advantage of the market. That's all very exciting. But having the additional stress of worrying about family members and the health consequences of the virus, if they caught it, I found was very stressful. I particularly worried about my parents. So that was hard.
And then you also have challenges of homeschooling too, right? On top of that. So that's
I think I let that slide a little bit. Maybe my kids are a bit behind. I could not do that, but have great appreciation for our teachers that
yes,
do.
yes. You did not sign up for that.
Speaking of COVID, what's keeping you up at night right now as a fund manager and investor? What are you thinking about?
I try to look at the factors that I can control and what I can't control. And when I talk about having net cash companies and good fundamentals, like good free cash flow, good returns on invested capital, it's to limit poor outcomes. So I try to control what I can. And the quantitative factors are things that you can control. We might get some of the qualitative factors wrong. But when I look at the macro, I remember Peter Lynch, and I'm going to paraphrase here. I'm not going to get it exactly right, but he said something like, you spend more than 15 minutes a year worrying about the market, you've wasted 13 minutes. And you can't control what the market's going to do. All you can control is what you do. So you really have to just focus on having a portfolio of companies where you're comfortable with the risks that you're in. And so that's what I do. And so I don't stay up at night worrying. Other things keep me up at night, but not my companies because of the way I've structured the portfolio, I'd say. I almost look at it, risk management, as you take your health seriously to reduce probabilities of a serious event occurring. You might still get hit by a bus or something like that, but you try to minimize the chances of a permanent loss of capital. And that's really what I've been trying to do. And then I try to employ routines and checklists to make sure I'm not missing things along the way. Checklist Manifesto was a good book that demonstrated to me the importance of having a checklist. And so I've tried to do that through investing as well and minimize negative impacts. So maybe this would be a point that might keep me up at night. In the 1960s, I believe about 18% or so of the S&P 500 was replaced every decade. Today, it's over 40%. So I am always trying to say, is there something in one of these businesses that can be displaced by technology?
Sure. And that's only speeding up.
Yeah. And that's speeding up. And we're seeing like a scenario where Google, everyone was comfortable with it just over a year ago. And today, is Google a growth company anymore? Don't know. From a 90% market share, could they be 70%? Still have a nice market share, but maybe advertising revenue also comes down. They've got a second challenger. Now Apple might say, hey, maybe we'll use Bing as our default engine, and they can get some pricing discussions with Google, which they couldn't have in the past in terms of being their default search engine on Safari or something. Anyways.
Good point.
Yeah.
Yeah. This AI revolution is very interesting and it will be entertaining to watch for sure. I sure have enjoyed toying around with Chat GPT and
It's an indispensable
Google's.
tool now
Mhm.
in daily life, especially for people like us. It's been fantastic.
Yeah, it really has. Ben, I'm curious how you would describe your leadership style preference.
Now, I'm biased on that point. I've seen the decentralized approach work so well at Fairfax. I could not think of a better way to do it. It really empowers the individual to make decisions. I'm going to put my Fairfax hat on here, but every CEO runs their own company. And by doing that, you're much less likely to lose the talent in the organization. They want to stay there. And then we overlay that with the golden rule. So everyone treats everyone with respect. And that's vital to it. So I really think of it as decentralized collaboration, where our subsidiaries, they operate day to day autonomously, but key decisions, and my dad talks about this at length as well, key decisions at the head office, of Fairfax head office, meaning investing for the insurance flow, M&A transactions, and dramatically expanding or contracting a major line of business. We're talking the billion-dollar lines of business within the insurance company. Those are discussed at the head office, but day to day and everything, bonusing and all that's all done at the company level and not discussed at headquarters. I read a book by D. Hawk, the founder of Visa, and I thought he had an analogy that really summarized why decentralized approach works. He said innovation came from subsidiaries scattered across the world rather than from just the headquarters. But if there was a mistake made in the organization, that idea died quickly without really impacting the subsidiary too much. But if you had a success, a great idea, it was swiftly emulated and it spread throughout the organization. And when you're keeping the talent, you have those kind of people that are bringing up those kind of ideas. Fairfax, our presidents, our CEOs have been with the company over 20 years. So they've got our culture ingrained in them. And that's only with internal candidates. If we took an outside person to run one of our insurance companies, then they'll bring in their people that they're comfortable with, and they'll run those divisions within the business. Pretty soon, all the management of that company are people outside the organization, have nothing to do with their culture, and they won't know it. So we have now over 16,000 employees in over 100 countries. We have a lot of talent in the organization. We don't need to look outside. And we've got a system in place that fosters a no ego culture, which is key to the decentralized approach. And that's what makes it really work and where ideas really rise to the top. And I also found an idea from Jamie Dimon, which I think he really explained why the decentralized approach works too. He said, it's not the value of what's on the balance sheet that's the value of the company. It's the extraordinary human capital. If you think of a great athlete or a great artist, it's not the equipment that you provide them with. It's the system that they've been trained in and the hard work that they put in that makes them great. And sometimes it's not the most talented individuals that win the championships. It's the team that delivers a championship. And so I just thought those were two great points on a decentralized approach and why it works. And
Yeah, Berkshire's also decentralized. I'm curious, do you think that's a concept that can apply across industries?
yeah, I think it can. One example of one of the executives that I talked to at Fairfax, he's one of our CEOs that runs one of our multi-billion-dollar businesses. And he said he tries to take that decentralized approach and uh, put it on steroids in the sense that within his company, there are lines of business that are $1 billion and they are decentralized too. So they are their own CEOs of that line of business. He doesn't get involved with the day to day or anything like that, but they report to him and he's let it grow that way. So I think it can work with all sorts of companies, but you need to have a no ego culture. And that is against the grain for a lot of companies. The average CEO in an S&P 500 company is about 7 years, I think, something like 7, 8 years.
Yeah, the tenure.
So what is your goal when you're only going to get the job that long? Make as much money as possible is what they try to do, what they're doing when they come in. And this is the kind of thing that is not well appreciated. And I think our family helps benefit the company from this is protect against this. We keep the executives focused on the long term and not on the short term. So executives at some of these other companies, when they think they're only there for a short period of time, if they're not going to make their quarterly earnings, they could sell a line of business and that would make their numbers. But that might not be the best interest of the company long term. Now, that won't happen at Fairfax because we're there for a very long term, but it could happen at these other companies.
A lot of investment managers have noticed that and will even look for companies that have some sort of family controlled. Of course, Fairfax is family controlled.
Mhm.
Why do you believe that's an asset for the company? And how are you going about preparing the next generation for leadership?
Thank you for that question. The commitment goes beyond just thinking of it as a company investment or a share price. We are there for the long term. And I think of all the families that are dependent. So we have over 16,000 employees, but you think each family member has 5 people dependent on it. You got almost 80,000 people that are dependent on the success of Fairfax. And so how does it last? And my dad always talks about creating the 100-year company. And these are the things that we are going to help protect to make sure that are always ingrained in our company. Decentralized collaboration, I had talked about that. An open communication culture. And that can only happen, again, in a no ego system where ideas are free to spread and people are free to also say if they don't think something is right. And then the ownership incentives are aligned for the long-term goals. And I was, briefly mentioning about how in a short-term focused organization, business might be sold and it might look good for the quarterly numbers, but not good for the long term. We're okay being offside for a long period of time if it matches with our long-term goals. Keeping a lean structure at the head office so we can make decisions very quickly and we don't get, you know, caught up in bureaucracy that we can't make a decision. And then integrity, tell the truth and make the best decisions for the company. And then we also have teamwork and loyalty. And in terms of loyalty, I know behind the scenes, my dad had talked to all the CEOs of all their companies and said, this is not the time to let go of anyone. We never like to let anyone go, but particularly during COVID, they won't get another job. And we didn't know how long this would last. So he made sure, no problem if the expense ratio is higher in this scenario. We want to take care of our people because they perform for us. And then the balanced entrepreneurship. We want hard work and measured risk taking, but not at the expense of someone's family and not at the expense of the company. Those principles, the next generation's challenge is really to uphold those principles to maintain our culture, but it's set out and mapped out for them. And so there shouldn't be a question in their mind. And I know I'm going to raise my children and Chris is going to raise her children, understanding these principles and these concepts and how important it is to the company and why it makes the difference.
It's real at Fairfax. I always say that, and I don't want to talk about Fairfax too much, but before going on the board of Fairfax, I don't know that I really believed how important a company's culture was. And at Fairfax, you just see it at work. It's there, it's in the room with you. It's very well understood what the company's culture is. It is no ego, very humble culture. And I think it's extremely important to Fairfax's success over the long term. So I've really learned a lot looking at that. Now I try to evaluate that in the companies that we analyze. Do you look for that in companies that you research? How do you identify it?
Yes. If you can find a company at a good valuation that has a family behind it that shows good discipline and rewards shareholders in the long run, then yes, you should invest with those companies. And I'd give the example of Walmart. Sam Walton died in 1992 and the company has grown and grown. And the only people that have really stuck with that company the whole time, maybe there's 5 or 10 others, but it's really the family that's held on to the company the whole time. The family owned businesses are the best investors because they just hold on to their stock the whole time and
Very
do what's right.
long-term focused.
Yeah. And so you try to find those kind of companies and because they're not making short-term oriented decisions, it doesn't show up. It's not in the numbers per se. But you have to understand from the CEO or the chairman's writings to them and how he talks about the company. And then look at his track record. Does it back up what he says? I think you have mentioned in the past that Sir John talked about making 200-year investments. And so when we're trying to make this 100-year-old company, right now we started since 85. At the time, there were 6,000 companies that were around in 85, and of which only 600 are around today. And we're of the top 20 in terms of returns since then. So we're in the top 1%. And I say that with pride because of what our company has tried to achieve. And what my dad has set out with this company is to make it uncommon amongst uncommon companies. When I say uncommon companies, in terms of the S&P 500 type companies, because those are the best businesses in the world that have been created. We talked about how companies are being displaced. 40% of them are falling out of the 40.
Yeah, that's incredible.
S&P 500. So you have to be uncommon. You can't go the common route and think you're going to stay there. It has to be uncommon methodology to remain in that S&P 500. And most activists, I was trying to do research on activists that have held their company stock over 20 years.
Oh,
You're just not going to find
there
it.
are
Right?
any.
No,
Are there any? I don't think so.
There'll be one-offs where someone's
Yeah.
held it or maybe not been able to get out of it. But for the most part, you're talking like 1% of the investments or less. So activists generally, they're never there longer than 5 years or something like that. So they're not ever coming in for long-term interest of the company. And
They have
even
conviction,
they
but
don't,
they're not long-term.
right. So our family control will keep the management team at the company. We're going to back the management team, keep this culture in place and keep the long-term focus on the whole company for the value of our shareholders and all the people that are involved with Fairfax too, that work at the company, our customers, all our relationships and everything. I think they will see that we do things at the highest level of integrity. You do see them in India. My average company in India, the founding family owns 51% of the companies. To your point, you find that less in North America, but in India, a lot of companies started after India almost went bankrupt in the early 90s. And still the family keeps control of those companies right now.
Yeah, I love that long term focus. And those are so many good thoughts on family controlled businesses. It reminds me of the podcast we just released, I think this week, with Lawrence Cunningham, who describes the different type of shareholders they are in the market. And I think specifically of, I think it was either Warren Buffett or Charlie Munger, either one said, you attract the type of shareholder you deserve. And quality businesses can attract quality shareholders with this long term focus and mindset. And Ben, I'd like to conclude by asking you about your interest and hobbies. We know you play tennis. So is it tennis and investing or investing in kids? What are you doing in your spare time?
Reflected on what the meaning of life is to me, and it's to fall in love with the process of learning new things as they come into your life. And you take simple concepts and then replicate them over and over to compound your abilities. And so when I mean that coming into your life, health, when I look at that, I used to run into my 20s and then I hurt my knee and I stopped focusing on it. And I got to 25 pounds overweight and I hurt my back when I was about 39. And I was like, you know what? I thought to myself, if I'm 60, it's not going to get any better. So I decided to take a little time and research it, study like a stock. And that's what I think investing has done. I think, and there's books about that, like how investing is more than just investing, it's a lifestyle.
Yes, it
So
is. You can compound in all sorts of different
it's
categories.
not just money. And
Yeah.
so
No.
I took to studying this and I found this concept from a guy named Pavel who brought the kettlebell in the 90s from Russia to America. And he called greasing the groove. You don't kill yourself and you do low rep, 5 to 8, and you just keep things around. So I'll work out in the morning, yes, but I also keep a dumbbell around my desk, a kettlebell. So in between readings, I can just, bust out a few things. I have pull-up bars on the way to the bathroom.
Oh, I know you're in shape and you work out a lot. Don't drink alcohol, very healthy lifestyle. That's really smart, though. I may get a kettlebell to keep in my office because I lift weights.
I found this Canadian engineer that made this pull-up bar called his company's called Duonamic. I'll give him a plug. It fits on any wall. Sometimes I bring it when we're visiting places. You can hook up gymnastic rings. You can get actually a pretty good workout from a small
Okay.
amount of equipment. And then there's another
Duonamic.
Duonamic, and they're on Amazon. And then GoRuck. GoRuck is an interesting company. They make weighted vests and weighted packs, and you can just add a little bit extra weight to your push-ups or
Oh,
pull-ups
I
or
don't need
everything, and then
that.
just keep them around. And you don't have to do, again, 5 to 8 reps. Then
That
with
seems
intermittent
like a
fasting.
lot.
So studying that, then kids, of course, I always think you have to take care of yourself before you can take other people. And then kids has been a focus of mine. I only say this because you might have people listening to this podcast that either are about to have kids, have young children, or might have grandkids. I didn't see this talked about a lot. Reading is a superpower. It really is. You can learn so much in a lifetime from it. And as we've talked about, compounding. So to give your children the gift of reading at an early age, I think is something special. So you could focus on making them great at skiing or whatever. I tried to focus on reading. And what I found is when my daughter was born, Clayton Christensen had written a book, How Will You Measure Your Life? And in there was a study, it was called the 30 million word cap. And it showed how some kids learn how to speak quicker than others. And it was because they'd heard many more words, up to 30 million more words than another kid by the age of 3. So when I was looking up that study, I came across something called the Dolch words, DOLCH, which are high frequency words. So basically, the concept is there's 200 to 300 words in the English language that encompass 50% of all the words in books, magazines, whatever you're reading in English. And in children's stuff, it's almost all the words that they would read. So if you teach them all those words from like the time they're born, they'll be vastly ahead. You would get more out of school if you can read all the instructions, read everything that's in front of you. So I think it's a gift you can give your kids. And my kids both read a couple grades above their reading level. And I just I didn't see a lot about that out there. And so I think there's a website, Mrs. Perkins, Dolge Words. If you search, Google that, you'll find it. And she has all of them on there. And you just take your kids through it every day for 5, 10 minutes. They'll learn the
I
word.
loved it.
So that was a focus of mine. And then you learn other things. Relationships become very important. So creating traditions with the kids, like trips alone. I was talking to a dad, he's 60 and he takes and his daughter's in her 30s. They still take a trip alone every year. And even though she's married and has kids and everything. So I'm like, okay, I'm going to create that now. Hopefully it lasts with both my kids. So
Great.
doing that. And then even with friends, like I find, I'm sure you have a lot of clients, I have hundreds of clients, and you can get wrapped up in work that you forget about personal relationships. So I've just tried to put in rolling either calls, coffees, or lunches with people in my life that are important. And it's just a rolling calendar appointment. And whether it's monthly, quarterly, or whatever, it comes up. And then if we have to move it, we have to move it. But we're going to do it and it stemmed from a friend of mine in Kenya that I saw 3 times over 5 years. And I said, if we had a quarterly call, we would have talked 20 times. And I also looked at some 100-year-olds and they had said the one thing that they cherished most in their life were the relationships that they made from 50 years on and that they kept. And so I thought I got to increase that in my life. And now with the tools we have, it's easy to do
Yeah, it's
and then focus on
amazing.
that. And lastly, stoicism, I think has been something that I'm really looking into the last few years. And I can't wait to learn more and more about it.
Quite the buzzword in that value investing industry. Everybody's talking about stoicism right
It's,
now.
it does apply to investing in the sense of you manage what you can control and what you can't control, you don't worry about. You're trying to foster and maximize your positive emotions, minimize your negative emotions. I think you even mentioned, John, this isn't quite negative emotions, but if there was a thought that
Mhm.
was unproductive, he would banish it or something.
Yes, people love that quote. He really did say that to me. He said, "When I encounter a negative thought, I just banish it to the nothingness that it was." And I think the more you think about that, you're like, wow, I need
So,
to do more of that.
yeah, they even have a concept of mourning a person that's alive, almost like they had died, so that the next time you see them, you appreciate them more. There's just there's so much to it and I need to study it more and more, but I really like a lot of things out of it. And so
Ben, where are you studying stoicism? Where do you start?
I think Ryan Holiday has done a fantastic job. Like if I give you Meditations by Marcus Aurelius, you read it, you won't get as much out of it. Ryan Holiday has written many books on the subject. I just made a book list actually. My friend's son graduated from high school. And so I told my friend that I'm going to pick out 6 books that I think I would have loved to know at his age. And when we graduated, there wasn't the kind of materials that there are today. And there's so many good books to give people. So the Daily Stoic was one I gave him. It's just a page every day to read. I'm going to give it to my daughter when she gets a little older. She's 11. And so there's a lot of topics she's not quite ready to read about, but maybe when she's a teenager. But the Daily Stoic, daily reading every day with a teaching on Stoicism.
I will
That's
be
a good one.
ordering that right
And yeah, it
right
was
away.
great. And then the other books that I recommended to him. And so if you've got a recent college graduate or someone graduating high school, I think Atomic Habits, and I think you
Yes, it's a
mentioned
good one.
that's a
Mhm.
great one for starting and maintaining productive routine. Think and Grow Rich. Someone gave that to
Mhm.
my dad on a train in India,
That's
Napoleon
yeah.
Hill, and someone just gave that to him randomly, a stranger. He gave it to me too when I was growing up, and I thought it was fantastic. But Power of Positive Thinking. I think the Almanac of Naval Ravikant was another great book with a lot of wisdom. The Psychology of Money, how to
Yep.
save, and Morgan Housel, and not to get wrapped up into all the trappings of conventional thinking of money. And then The Joys of Compounding. I think that book has done a phenomenal job of taking what's in the past of value investing and then also incorporating more modern, like Jeff Bezos and those kind of people into the book and some of their teachings as well. So I thought he did a good job. So those are the 6 books that I gave out
It's a
to my
great book.
friends. I think
That's
I'll leave it there.
awesome.
Yeah.
Thank you for sharing that. And I will make sure and list those books out in the show notes for anybody who's interested. You don't have to write it down, I'll have it on the website for you. Ben, this has been so much fun spending time with you today. I just really appreciate your time and thank you for coming on Investing the Templeton Way.
Yeah. Thank you, Lauren. Thank you so much for taking the time to interview me. And I really enjoyed myself today. And I'll look forward to talking to you in the near future. Thank you so much.
Wonderful. Okay. Bye bye. Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.